February 19th, 2025. Today was pretty much a bull trend day. You could argue it's a bull channel. I thought of it a little bit more as a bull channel day. And we obviously channeled all the way up to a new all-time high. My platform's been a little laggy, excuse me. Okay. Coming into the day, there was something really important, and that was we had three legs up here. One, pull back, two, pull back, three. So we have three legs up to bar 78. What does that mean? Well, third legs in general are going to get tested. We're probably going to test the high of 78. However, when you have a third leg, the market often falls below the third leg. So assuming it's a bull third leg, the market often falls below the third leg before it ends up retesting the high. So buying the close of 78 with a stop below 77 is not really a good idea. In theory, if you're holding overnight, I'm saying pretend it's a continuous chart because of the fact that we probably will test the low of that leg. However, you could buy the bar 77 low. This is really my platform's just really slow right now. I'm sorry. But you could buy the bar 77 low with a stop, a measured move down, and I bet you have, a 60 to 70%, maybe a 65% chance of making money. So I think that's a pretty reasonable thing to do. So, again, when we talk about tight channels, the whole concept of tight channels, this whole rally up from the bar 8 low, the bar 31 high was a tight channel up. So it's essentially a leg one, leg two day. And one more point about, 77 and 78. This sort of stuff I talk about a lot pre-market. I make a pre-market analysis for myself every day, but I decided that if you saw my post, I decided that I'm going to make it available for members. You can see the post. I put the details in there, but I'm gonna make that available for members starting tomorrow for at least a month or two, and start doing something along those lines. To be honest with you, one of the things I like, to be fully transparent about having a YouTube channel, is the fact that I get to monetize my studying. Everything, all these daily reviews. I've been making these daily reviews for 5.5 years. It's just I used to write them down or I'd record them on my phone, and eventually I just decided to start posting them. And I would encourage you guys to do the same thing. If you're, if one of the ways you study is make a daily review, just post it. Just post. Why not? There's no reason not to. The worst thing that can happen is nothing. So I would really encourage you guys to do what you can, because if you can monetize your studying enough, and you don't have some other form of support, then you might eventually be able to essentially make a living off of some sort of channel, and that could help you a lot in the ways that you could do that until you're able to trade for a living. But that's enough of inspirational speeches for today. Back to trading. So we have this. So I was expecting coming into today that we were going to test up to this high at some point. The Globex 15-minute chart needed probably one more small leg down. So you would expect that we're probably going to go a little bit more sideways to down. However, probably not all that much further down. So what needed a second leg today? Well, there was a lot of important stuff. None of this in here is large enough to truly need a second leg, and something to consider, maybe 7 does, but 9 is going to be your second leg, right? So you have to think about second legs and tradable second legs. And the larger picture you can see, the better you're going to do, because you're trading simple legs. So, what some people might do, what they would get caught up in second legs, is they'll see that 7 needs a second leg, and they'll sell the close, try to scale in, maybe break even, something along those lines. That's really difficult to do. You're gonna struggle at some point or another. The easier thing to do is look for the big, simple second legs. Stuff like 9 through 31 is going to get a second leg. And so you wait for the bulls to start to get their reversal back up, and then you look to buy, maybe above bar 46, something along those lines. So the bigger and more simple the second leg is that you're trading for, probably the better you're going to do as far as being able to trade. Something like 10 through 13 is going to get a second leg. This is the classic 4-bar micro channel, the study I talk about. You would buy the close of 13, go for a measured move up. I used to do based on bodies usually. So the study is based on the height of the bodies, but somewhere up here, you'd buy the close and go for a measured move up. If you do have the 4-bar micro channel study and you've been studying it and you've been trading it, one of the things you'll notice is it gets absolutely rinsed against tight channels. So it's a really, really difficult trade to take against tight channels, and it needs immediate momentum. Otherwise, you need to get out. And that's sort of the thing about momentum trading, right? One of the trades I took today, I bought the close of 31. I bought the close of 31 knowing it's a late leg. Why did I buy the close of 31? I bought the close of 31 because I thought it was likely that we got to the all-time high today, which was 6163.75. So I bought the close of 31 in case we got a vacuum test. Does 32 look like it's going to start a vacuum test? No, it just looks like a doji bar. To me, that's bad follow through. And again, if you're trading in early legs, bad follow through is more acceptable. I talked about this yesterday with, this rally 13, 14, and 15. The early leg, bad follow through, you can add on that close because you're going to get a second leg. The late leg bad follow through, you cannot add on. You need to be quick to get out of your trade. So I bought the close of 31, and when I got disappointed on 32, I just exited the trade. I gave 33 maybe 10 seconds to wow me, and when it didn't, I just exited the trade, and I got out essentially at a 1 tick loss. And the thing about the thing is, if you've been trading for long enough, you probably have a lot of times where you make a prediction, like today, let's say you thought we were going to the all-time high, but you took a trade, you took a loss, and then you took a trade and you took a loss, and then you didn't have the heart to buy again and you got trapped out. Well, that's just kind of what trading is. You're going to get trapped out even if you're right. So you have to learn how to just continuously stick with the idea. So I bought the close, I got disappointed, I got out. I bought the close of 40, 49, same premise, and then disappointment 52, got out close of 52, so small loss here, very small loss here, and then I bought the close of 56, and then this trade obviously makes up for these two small losses. The other trades I took today, I bought the close of, this is actually really interesting. I'll go through. I sold the 66 low during 68, and I got out at the low of 68, or basically the moving average. So I sold here and I exited here. I bought the bar 13 close and I scaled in on 18 and exited at break even. And then I bought the bar 20 close and I scalped out on the close of 21. The really interesting thing about bar 18, when you get a deep pullback like this, 16, 17, and 18, most traders are expecting a second leg. The reason that I exited my trade in the first place, so when I bought, the reason I scaled in and got out was because the pullback was deep enough to make me think that 18 should get some sort of second leg sideways to down. And I wrote in my notes that when we got 18, we should not get consecutive bull bars closing near their highs. It would be unusual for us to get consecutive bull bars closing near their highs. And then what do you know? We get 19 and 20. And so, one of the things I would challenge you to do with when you exit a trade, what would it take to get you back in the trade? So even if it's as simple as another bull bar closing your tie or whatever it is, when I exit this trade at break even, I basically wrote down what I think probably would not happen for the bulls. The reason I'm exiting the trade is because this should get a second leg and we should not get two really strong bull bars here. And instead, we immediately get two strong bull bars, and the bears who sold the close of 18 or above 18, they're instantly trapped on 19 and 20. And so you can buy this close. And so, if whatever it is that you're doing, let's say you took the same trade and you wrote, or let's say, I don't know, let's just use this as an example. Let's just say you sold the close of 56 and you see 57 and 58 and you write down, okay, we should not get a big bull bar here. If we get a big bull bar, my trade's in trouble. We're probably going to go the other way. And then we get the big bull bar. Well, now you can just buy this close because we got the surprise, the unusual thing. And so if you're exiting a trade, you should immediately write down a plan to get back in so that, in real time, because you're less objective in real time, right? So you write down a plan to re-enter. And then when that plan starts to happen, right, when you get these consecutive bull bars, you have that note from objective you 10, 15, whatever it is minutes ago. And you can say, okay, I said if this happens, I'm getting back in. So I have to get back in now. And sometimes you'll lose the trade when you get back in, but that's fine. It's about learning how to stick with the plan, because even if it's not a good plan, eventually your plan will be good. So this whole move, 16, 17, and 18 should probably get a second leg. But when traders get trapped, 19 and 20, you can start buying closes, betting that the bears are going to get forced out. And, it should lead to 2 to 3 legs up. We do get 3 legs up. 1, pull back. 2, pull back. 3. You look at a higher time frame chart, a 15-minute probably won't display it well enough. Maybe a 30-minute will. Right. It's a 4-bar micro channel on a higher time frame chart. So if you were trading a 30-minute chart today, you could have just bought the close and you would not quite have gotten the measured move, but you'd be close and you'd be making money. So again, the point is, when you see these tight channels, whenever you see a channel, you should think of it as a breakout on a higher time frame. And if it's hard to believe that, just go look at the higher time frame. For me personally, when I see the breakout from 9 to 31, I don't have to look at the higher time frame anymore. I know it's a breakout on a higher time frame. But if you're struggling with that idea, just go look at the higher time frame and examine the breakout and see what you think about it. So traders, and the 4-bar micro channel, by the way, is also it performs very, very poorly in two situations. One of them is against really tight channels, and the other one, I have found at least, is at the end of bull trend days or bear trend days, right? So if you get a 4-bar bull micro channel at the end of a bull trend day, it performs very poorly. If you get a 4-bar bear micro channel at the end of a bear trend day, it performs very poorly. And so here, when you get this 4-bar micro channel, I'm not looking to buy this close. I'm looking for the fade. And so that's why I took the short at the 66 low. I got out. You could hold for one more leg down because the breakout point, the bar 56 high, might have to get tested. Why? Because in general, if you sold above 56 after 4 straight bear bars, you'll probably end up making money if you're willing to scale in. And those traders who have scaled in, who got trapped on 57, they get let out. Traders are going to get let out in general on trend days, on trading range days. This was a little more of a channel day that has converted into a trading range, but these will all be magnets later in the week. Whenever we reach this bar 18 high, if we do it tomorrow or Friday or whatever, there will probably be some sort of support in that area. So this needed a second leg. I did take one other trade today, actually, got to mention. I sold the close of 36 and I was disappointed in 38 and I got out. I sold the close of 36, taking a chance that this day converted into a trading range day. I knew it was possible this was a bull trend, but I sold the close, taking a chance that we get a collapse to the bar 18 high. My expectation was that we went straight there because I don't want to sit through a pullback against a tight channel for this exact reason. I've sat through it too many times and it's really, really difficult. So I just got out on the close of 38 for a very small loss. 33, 34, 35, 36, and 37 definitely does need a second leg, though. If that was your thinking in shorting, you're not wrong, but you have to realize that you're selling against a tight channel. And so, you might need to scale in higher if you're going to be doing that. And look at the resistance area we hit. The bulls who bought the 32 low and were willing to scale in lower were able to make money. So if you're going to be buying up here, it goes back to the momentum trading thing. Again, you have to classify a trade as either a momentum trade or a leg one trade. That's how I tend to classify my trades. If it's a leg one trade, then you can, it's the first leg, you can sit through the pullback and buy more. If it's a momentum trade, like a lot of swing trades are, then you need really fast follow through. Otherwise, you just need to exit the trade. You could have sold the close of 42 or 43. By the time you get 43, it does need a second leg, and it does trade below the 37 low. 33 through 37 needs a second leg, and it does get the second leg, and that is completed on bar 45. 46, that's an always in flip. I think 46 makes the market back to clearly always in long, and until the bears can get something that essentially forces the bulls out, I think we're going higher. So you could have bought above 46. Like I said, I was making lunch, so I did not end up buying above 46. I bought a little later, 49, got out 52, bought again 56. And you just have to learn how to stick with the idea. And the rally to 57, 58, 59 is going to get a second leg. We have a spike up to 59 and then a pullback and a little bit of a channel and then a two-legged correction. So to me, channel, then trading range. So I think this is a trading range. And assuming no gap tomorrow, we'll probably start the day with this as the range. Remember, if you have a bull trend, all the lower lows or the lower highs are support. So if we start to sell off tomorrow, this area is support, this area is support, this area is support. Like I said, as far as entries on the day, you could have bought the close 13. You could buy the close 19 or 20 or 21. You could probably, I don't know. It's sketchy to buy up here. You got to know what you're doing. If you're going to buy up there, you have to be fast to get out. You can't be hopeful in the trade. Hope ends up crushing a lot of traders who take momentum trades because it doesn't give them what they want. And then they just say, oh, well, maybe it'll happen. And then that's how you inevitably get trapped. You could sell on the way down. You could sell 33 for a second leg since it's 3 legs up. You could sell 34, 35, 36. But if you're selling that low, again, you're betting on a collapse. So you have to have the proper expectation there. 39, 40, maybe you can buy, but 33 through 37 is going to get a second leg down. It needs to complete that price structure. So I'm expecting the market to fall one tick below the 37 low. So if you're buying 37 or 38, 39, 40, you're expecting a bounce to the 32 low and you probably need to get out pretty quickly or just get out below 42 or 43. You can sell 42 for sure or 43. You get the second leg down. We have a tight channel up and this rally 38 through 41 hints to you that it's not going to be a strong bear trend because why are we getting 4 bull bars closing near their highs if it's going to be a strong bear trend? And then you can buy above 46 and just hold. I would not sell any of these personally. And I don't know if I'd buy up here. It's too close to the all-time high, and if you buy close to the all-time high enough times, you're gonna get a little too traumatized to trade near the all-time high anymore. So I personally have just bought around the all-time high way too many times and just watched the market reverse on me. So I don't do that anymore. When we rally like this to the all-time high, I immediately start looking for a short. The daily chart. As you can see, we are at an all-time high, but is it moving in a way that makes you think it's going to be a giant bull trend? No. So while we might go a little bit higher, I do think we go higher. I'll say that. I do think we go higher, but I'm not sure how much higher. And I'm looking at this high, the 6,100. And I think we might have to get there at some point. The weekly chart, we have two bull bars, here and here. But again, a lot of overlap. Look how much overlap there is, right? If you bought this high tick, this high close in December, you're not even up 1%. You're barely up 1%. So it's not like we've really gone all that far in the past 2 months. So again, I'm expecting, it to be a little bit more sideways to up, but I still think for now we go up simply because, as far as the S&P 500 goes, I'm bullish all the time until we get something that's clearly bearish. The problem with trying to short weekly charts and stuff is exactly as follows. Well, look at a yearly chart. The problem with shorting weekly charts is the yearly chart. Why would you sell, right? So it's always going to be in a bull trend. So trying to time the market, that's why, when you're buying your 401k or whatever it is, you can just buy the market and it doesn't matter. But for selling the market, it's really, really, really difficult to do on higher time frames. And it's a lot more effective for day traders, at least on a 5-minute chart, 10-minute chart, whatever it is, some sort of intraday chart, or even a daily chart is probably pretty reasonable, but a lot harder to do on the higher time frames. All right, that's going to be it for this video.